Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. COVID fears spook markets as cases continue to flare up in China. Benchmarks end the session flat. Broader markets, the clear underperformers today. The declines in trade led largely by metals, realty and PSU banks. Reliance Industries further cements its position in the retail market. Subsidiary Reliance Retail Ventures, led by Isha Ambani, buys out German B2B wholesaler Metro Cash and carries India business for 2,850 crore rupees. India's favorite financial instrument makes a comeback with returns nearing 8%. Is it the right time to lock your money in bank fixed deposits, or should you wait for a few months for the interest rates to rise even further? Shout out to our loyal viewers. Business Today website records a whopping 98.2 million unique visitors in the month of November. Data from Comscore puts BT much above industry giants like CNBC and Bloomberg. Volatile moves continue to plague the Indian market. COVID fears impacting sentiment, leading to a third straight decline for the Sensex, ending the session lower by 240 points. The Nifty closing above 18,100, albeit still in the red. The six sectors that led the decline today: metals, autos, real estate and PSU banks, high beta names taking a hit. Some of the top laggards including UPL, M&M, Isha Motors, Bajaj Finserv, IndusInd Bank and BPCL, all locking in losses upwards of 2%. Not entirely a day of red. We did have some mild gains on stocks like Sun Pharma, SBI Life, Infosys, Asian Paints, Ultratech Cement and Kotak Mahindra Bank. Indian businesses are nervously watching the spread of COVID in China. It's déjà vu for the Indian supply chain, which went off the rails in previous lockdowns. Particularly, it's the dependence on raw materials from our northern neighbor, which is sending chills across boardrooms.
These scenes from Lok Sabha this morning reinforce the creeping sense of dread. India's top political leadership sending out one simple message: the masks are back. And more than anyone else in the country, it's industry which is getting the chills. Just when everyone thought COVID was behind them, just when the economy was reopening from the catastrophic lockdowns, just when travel and social interactions had picked up, the virus has struck back with a bang in China. Unbelievable scenes like these have seeped out of the Iron Curtain around China, laying bare the Xi Jinping government's lies and narratives around the spread of disease in the country, the failure of its zero COVID policy. Infections are already at an all-time high, and epidemiologists have warned that 60% of China's population will be infected within the next 3 months. For businesses in India and around the world, this portends a complete breakdown in supply chains. It's not for nothing that China is known as the world's factory. For manufacturers in India, ripples of worry are spreading across sectors, from electronics to apparel, metals to chemicals. Importers in India have already been warned of production slowing in Chinese factories due to employees falling sick. The Chinese New Year holiday is also just a month away, and millions of Chinese workers are expected to head home to their villages from the big manufacturing hubs. Many Indian companies are already placing bulk order to preclude the possibility of the tap being turned off. Even mobile phone companies are raising the prospect of running out of components if the situation in China worsens. India's dependence on Chinese raw materials is reflected in these export-import figures. India imported a record $94 billion worth of goods from China in 2021-2022 against exports of $21 billion. The biggest worry is that a shortage of supplies from China could drive up commodity prices worldwide, not only affecting the availability and prices of household and industrial products, but also of food materials. Bureau Report, Business Today TV.
Business Today TV, in fact, conducted a poll this morning on the spread of COVID from China. Our question was, should India stop allowing air passengers from China? The response was overwhelmingly in favor of stopping flights, with 89% of respondents voting for this option. Just 11% were in favor of flights continuing between the two countries. Who better to discuss the impact of COVID on India than one of the oldest and largest industry federations? Here's Business Today Managing Editor Siddharth Zarabi in conversation with the newly appointed FICCI President, Subrakant Panda, who's also the MD of Indian Metals and Ferro Alloys.
The reason I am linking this to COVID is primarily on account of fast changing sort of sentiment over the last 2-3 days this week with respect to COVID and its impact on the Indian economy, Indian business, which has recovered to a large extent from the earlier lockdowns. What's your own sense?
My sense at this point in time is that we should not panic. There is a need to be vigilant, which is what is happening. In the sense that the government is on top of things. The health secretary has written to the states and other stakeholders to increase the level of alertness and do genome sequencing so that we are able to pick up any new strains if that were to happen. But you know, the information coming out of China in the last couple of days, I mean, this is a society where news flow is tightly controlled. So you don't know whether something is either being underreported or what is escaping through is hyperbole or reality. It's very hard to tell. And I mean, things will become clearer in the next, I would say, 5-7 days or so. I believe the World Health Organization even today has called upon China to share information about what is happening. And until we have more authentic information, I don't think we should get carried away. And there is certainly no need to panic. From a Indian perspective, the population is by and large fully vaccinated with 2 doses, and a large number have got the 3rd precautionary dose as well. So we are about as well prepared as we can be. And from a business perspective, again, cyclical sectors are, have deleveraged their balance sheets to a large extent. I mean, you have a situation where there is a large reserve of foreign exchange, so that we are, which is being used judiciously, and that's about what we can do.
That's a fair assessment. I want you to dwell a little bit more on the preparedness of Indian industry. We saw the first lockdown and how Indian industry rapidly adapted to that. And there are, several lockdowns behind us, the 3rd year of this continuing pandemic. How well is India and Indian businesses specifically prepared to deal with supply chain disruptions? Because that has been something that has spilled over into inflation and caused considerable pain to a certain segment of the Indian economy.
So, the point here, as I said, first and foremost, I wouldn't want to speculate that this is something which is actually out of control until we have reason to believe so. Yes, there is, the number of cases are spiking, but we know that to happen. And, more from the point of view of the Chinese people as well as the world, I really hope that this is something which is under control. Because don't forget that, there is a business aspect of it, as I said, that, I mean, if there is a disruption, unfortunately, then, that is something that we can't really afford or want at this point in time. But more than anything else, it is the human cost that has to be kept in mind. But, what is worth pointing out here is that our own track record of how we handled COVID has been far better, both in terms of, whether it was having a lockdown at the beginning when you didn't know what was going on, to a very well-conducted vaccination campaign, and finally a calibrated reopening which balanced lives and livelihoods. And I'm aware of that simply because I headed the COVID task force at FICCI at that point in time. And many of the suggestions we made, including a reopening matrix, was adopted in large parts by the government. In contrast, what you have here is a zero COVID policy which continued to the extent that it caused social unrest, and then you have a step back from zero COVID, which has been somewhat abrupt and which is leading to all these situations. But as I said, let's not speculate, let's not panic. There is a need for alertness and to be vigilant, which is what the government is doing. And as soon as we have more information, that's when one can deal with it. But from a corporate perspective, cyclical industries have deleveraged balance sheets, as I mentioned.
Right.
I mean, India is in a sweet spot in terms of where we are on the growth curve. And let's see. I'm confident in our ability to maneuver around whatever challenges there may be.
We are on the cusp of a new year, and the economic outlook, as far as the global environment is concerned, is not very certain. What's your own sense about the domestic inflationary scenario? Because that's been the one big thing that we have seen. The cost of capital has gone up in India, both for industry and consumers. What's your own sense about inflation? Will we benefit in a roundabout manner due to depressed global demand?
So, let me put it this way. Inflation has been a global phenomenon, no doubt, but like I said, I think both the timing and the quantum of stimulus measures in India have been spot on, because excess stimulus measures have led to elevated inflation levels which have been very stubborn in the West. From that point of view, and of course not to mention that inflation in India was by and large imported largely due to commodities and especially oil. So with commodity prices cooling off, there has been a positive impact in terms of inflation cooling off as well. And you now finally see, consumer inflation being within the tolerance band of the central bank. But this is not something that we should declare victory too early. One has to be vigilant in terms of ensuring that it doesn't rear its ugly head again. But having said that, it's important now to prioritize growth because that is very, very critical for us. And India is acknowledged as the rare bright spot in the global firmament, and that got a little brighter with the World Bank upgrading growth forecasts for the current year FY23. But the challenge, of course, for us is the global slowdown, because the IMF numbers show a significant slowdown in global growth next year from the present 6% to 3.2% and further slowing down to 2.7%. So that will present challenges. But equally the forecasts for inflation are that from a peak of 8.8% this year, it will cool off to about 6.5% next year and 4.1% in 2024. So this is something. Inflation is something that we have to be alert to. But India has done well with fiscal and monetary policy working in consonance to tackle inflation. And I believe the next budget, which will be the last full budget before the general elections, is something which will be growth oriented. And I was very enthused to hear the Honorable Finance Minister say that it will carry forward the legacy of this government, which I believe is reforms orientation, growth orientation, while extending a helping hand to those at the bottom of the pyramid, the vulnerable who need help the most.
Isha Ambani's Reliance Retail has made its largest acquisition till date, picking up the entire stake in Metro Cash and Carry's Indian operations for 2,850 crore rupees. The deal considerably strengthens Reliance's dominant position in the domestic retail sector. What it gives Reliance Retail is access to a wide network of Metro India stores located in prime locations across key cities, a large base of registered kiranas and also other institutional customers, strong supplier network, and some of the global best practices implemented by Metro in India. In a statement, Isha Ambani said the acquisition aligned with the company's new commerce strategy of building a unique model of shared prosperity through active collaboration with small merchants and enterprises.
Reliance Retail that has acquired Metro Cash and Carry for about 2850 crore rupees. Now, through this acquisition, Reliance Retail really gets access to a wide network of outlets and the retail and institutional buyers too, and a strong supply channel. I want to understand your point of view on this development and how is this really going to benefit Reliance Industries and Reliance Retail's venture as well. And also to take that point in the same breath, why are the shares really sulking at this point?
My sense is that this is a stock that you should possibly accumulate on all depths and hold on to it from a long-term point of view. And this acquisition that we are speaking about of about 2,800 crores of Metro Retail, I think it's a very thought-out strategy. Remember one thing, India has a population of 140 crores. And historically, we have been a consumption-driven country. When you have this kind of a huge consumption base, and when you have the appetite to cater to the demand of such consumption, then I think you are not going to go wrong when it comes to increasing your footprints in the retail segment with acquisitions. And I think it is a more stronger strategy because you, like you mentioned, it is a ready to available platform, the acquisitions, to increase the market share. So I think it's a well thought out process, business strategy. And with the kind of other businesses they have, digital, telecom, and they are venturing into green hydrogen. Historical businesses are looking quite strong. Refining is looking quite strong. So I don't think you're going to go wrong because you have a huge base of the pyramid to cater to, and you already have your presence and you're increasing your footprints via this kind of acquisition. So I think it's going to be a great business proposition, and the growth story will definitely contribute to the balance sheet.
Right. And this news also comes after the recent announcement that we actually saw that the company is going to be foraying into the FMCG space as well. So how do you look at that space too? And does that also add enough opportunity for shareholders and potential investors to look at Reliance Industries as a long-term potential buy?
Yeah, I think they acquired Campa Cola and bringing back the iconic brand back into, pumping life back into it. And it's only organic and inorganic growth, you can put it that way. You have your retail stores, you have your own products, and I'm quite sure, Sakshi, that going forward you will have many more products being introduced in the FMCG category by Reliance Industries. And my sense is that like I mentioned, huge market, huge population, 35% of it is young population. And I think there's going to be ever-growing demand. And not to forget, I think you will see traction from the, urban India, the metro cities, tier 1, tier 2 cities, but the appetite is going to be even much, much higher from semi-urban and rural India, given the agri uptick and the, income moving up to another level with direct cash transfer benefits. So I think it's, again, a great strategy to go ahead.
And here's what else is making news in the corporate world. Sula Vineyard made a flat debut on the Lal Street with its share listing at a premium of just 1% from its issue price of 357 rupees. The stock closed down 7.5% at 330 rupees. The IPO was entirely an OFS issue. Tata Communications will acquire the entire stake in New York-based media company Switch for around $59 million. As part of the deal, Tata will also buy the assets of the company in Canada and the UK. Switch Enterprises is one of the leading managed service providers for live production and video transmission. In a big boost for its exports, Maruti has signed a 5-year deal with Kamarajar Port near Chennai. The port will be used to export Maruti vehicles to Africa, Middle East, Latin America, ASEAN and the Oceania regions. Maruti is targeting exports of 20,000 cars from the port. Shifting focus to another important story, France's data privacy watchdog, CNIL, has gone ahead and slapped a €60 million fine on tech giant Microsoft's Ireland subsidiary. The French regulator accused the company of not having a mechanism in place for users to refuse cookies as easily as accepting them. Microsoft has been given 3 months to rectify the issue, with a €60,000 per day overdue. To add some context, the French regulator earlier also imposed fines of 150 and 60 million euros respectively on Google and Facebook for similar breaches. Till a few months ago, bank fixed deposits were considered one of the worst investments, with one of the lowest returns, taxable according to the income tax slab that you fell in. The real returns were in fact negative if the high inflation was taken into account. But as we see in this report, actions of central banks around the world have made the humble FD attractive once again.
For stock market aficionados who swear by lightning fast trades and overnight profit hauls, it was one humbling reality check they could have done without. One of their modern day icons, Nitin Kamath of Zerodha fame, brought their D-Street dreams down a peg or two with 2 statements. First, 99% investors who invest in futures and options trade have returns of less than 7% that an FD would give them over a period of 3 years. And second, Zerodha has more investments in fixed deposits than it has in stocks as part of its treasury operations. The statements just confirmed what the Indian middle class were slowly realizing over the past few months, that their favorite investment instruments were back with a huge bang. Fixed deposits, which were giving returns of as low as 3.5% to 4% just months ago, are now rallying above 8%. At the forefront, at the smaller banks, who with their lower brand recall are offering higher rates to attract depositors. Frontline banks such as SBI, ICICI Bank, HDFC Bank have lower returns thanks to their dedicated customer base. But one category which is really reaping the reward is the more financially vulnerable super senior citizen category of individuals above the age of 80 years. RBL Bank, for instance, is offering deposits at 8.3% to super senior citizens. Union Bank of India is offering 8.05% for tenures of 800 days and 3 years. Punjab National Bank has a special deposit of 666 days with a return of 8.1%. The rise in interest rates can be attributed in parts to a race between banks to mop in more deposits. According to an RBI report, while bank credit offtake in the July to September quarter rose 17.2%, growth in deposits lagged at just 9.8%. This has left banks with a gaping hole in their balance sheets, a hole they are trying to fill by luring more deposits. The other big reason, of course, is the 225 basis point rise in the repo rate in the past 8 months. RBI efforts which seem to be paying off with inflation falling to 5.88% in November. There are apprehensions that fixed deposit rates could plateau in the next few months as RBI gains ground in its fight against inflation. However, the good news is that analysts expect the return on FDs to rise by at least another 0.5 percentage point before this plateau is reached. Bureau Report, Business Today Television.
That's where we leave it on the show tonight. Thanks so much for watching.